Hi everyone, this is Mrs. V Chen. Welcome to my Form 6 Costs Accounting Lesson number 3. Today is 27th of July 2020. Alright, so we will look at the difference between financial accounting and cost accounting in today's lesson. Okay, so here we have financial accounting that you learned this in Form 4 and Form 5, right? So what is the purpose for financial accounting, which is mainly for reporting? And how do we do reporting? Okay, we follow this accounting cycle, is that right? We make double entries and then we do posting into the T accounts, and then we have the trial balance, and then from the trial balance we can generate income statements and statement of financial position. Okay, so however, the purpose of cost accounting is not for reporting, which is used for making decision. For example, whether we should buy finished products from the supplier or we should produce our own products. And then another example here is how much should we set selling price for our new products, so which is related to pricing decision. Okay, so therefore, obviously, for financial accounting, the purpose is for both internal use and external use. Okay, and to make decision, which is only for internal use. Okay, so for example, we have external uses of financial statement. For example, investors, potential shareholders and creditors and lenders, they will rely on our financial statement here, income statement and statement of financial position to make decisions. So therefore, when we prepare our financial statement, we must follow accounting standards and concepts to prepare this financial statement and through this accounting cycle. All right, but what about cost accounting? Since this is only for internal use to make decision only here. All right, so this is only, therefore we don't need to conform to the accounting standards. This is another difference between financial accounting and cost accounting. So therefore we have financial accounting focuses on past events, past transactions, and we just use double entry to start with the accounting cycle. However, for costs accounting, since we make decision for the things not yet happened, so therefore we focus on future events. Okay, so next we come to purposes of costs accounting. So since cost accounting focus on future events, and also we have resources being limited, however we want more, we have unlimited wants, and these two things combining, we have this scarcity. All right, so therefore we need to make choice, and then we need to do resources allocation when we do costs accounting. Okay, so therefore for cost accounting, we will look at opportunity costs. We study opportunity costs, and the definition for that is the highest valued option foregone. Okay, so whenever we have to make choice, okay, we will foregone something, and the highest value option being foregone, we call that opportunity costs. So therefore we have the last difference between financial accounting and then cost accounting, which is since financial accounting related to past events, so that historical cost is relevant to financial accounting instead of opportunity costs. But however, for cost accounting, since we have to make choice, and then opportunity costs is the highest value option foregone, which is relevant to costs accounting. All right, so here we have one of the cost accounting questions in A-Level 204, and then part here we need to define sunk costs and opportunity costs. So let's look at the definition of opportunity cost again. So here is the answer for opportunity costs. So which is the costs that measures the best opportunity that is lost or sacrificed, which is same as the value option foregone. When the choice of one course of action requires an alternative course of action be given up. For example, I give you this. Time is a kind of resources and which is always unlimited. now you're watching my video. If you're watching my video now, you cannot watch movie on Netflix at the same time. Is that right? So this is your choice for watching my video. Then what do you forego? You forego watching movie on Netflix. So therefore, this is your opportunity costs for watching my video, and which is the highest value option foregone, and this is the definition. And then remember that opportunity cost is only relevant in cost accounting, but not relevant for financial accounting. Okay, next we come to part B of the question, saying that Hunting Company, a local toy manufacturer, so that means this company produced their own products, and then had the following costs data for last year. So this data being past data which happened in last year. Okay, if we jump to this paragraph, and then we have this: an offer is received from an outside supplier for the supply of the component. Therefore, we have a supplier coming to us whether we should buy the products instead of producing our own product. So therefore, the related question in part B here, we need to state with supporting calculations whether Hunting Company should continue to manufacture the components, whether they should produce their own products, or whether should purchase the component from the outside supplier. Now, the most important thing is with supporting calculations, but what to calculate is not given to you for making the choice. So therefore, this is the most difficult thing and the most important thing for what things that you need to calculate in order to make choice whether we should produce our own products or whether we should buy finished product from the supplier. Okay, so therefore to make decision on whether we should buy or produce our own products, so we do this calculation, that is the costs of manufacturing, and then we compare costs of buying, right? So here, let's look at the question. So we are given this variable costs and fixed costs for this direct material, direct labor, so obviously this is related to costs of manufacturing. So here I put all the costs of manufacturing here. We have this direct materials, okay, so which is related to costs of manufacturing, and then we have direct labor 180,000. All right, and then we have electricity used in the factory for production, for manufacturing. Okay, and then we have indirect labor, which is 200,000, and then miscellaneous also incurred in the factory for manufacturing, right? Okay, now, and then we come to what about if we buy from the supplier, and then we have this annual requirement of the components is 30,000 number of units. So this 30,000 number of units is same as if we produce, we also produce the same amount of units. So in order to make comparison, the number of units for production and buying must be the same. Okay, and next, the price quoted by the outside supplier was 11.5 per unit. So therefore, for cost of buying, we don't need material, we don't need labor. However, what do we need here? We need purchased price from the supplier, and the price offered from the supplier is 11.5 per unit. And now how many? So which is 30,000 number of units. Okay, so here I have my purchased price if we buy the finished product from the supplier, which is 345,000. Okay, next we also have carriage inwards. That means if we need to transport the component from the supplier to our firm, so we need to pay this 1 per unit. So here I have this carriage inwards, and that is $1 per unit for 1 unit, and now the component unit is 30,000, so I also have 30,000 for carriage inwards, right? Okay, all right, next, indirect labor will be increased by 36,000 annually for receiving for inspecting, blah, blah, blah. So, okay, we also have indirect labor for doing the related jobs, but however, we need to pay more according to the information here. So how much is indirect labor? Originally, 200,000, so increasing, so it's how much more? 36,000 more. Okay, yes, and then plus 36,000, so that I have 236,000. Okay, so which is related to cost of buying. And here, point number 5, miscellaneous fixed cost 50,000 can be avoided. That means we pay less miscellaneous fixed cost than before if we produce our own products, if production of the component is discontinued. So we also have miscellaneous expense here, but however, we pay less, 340,000 minus 50,000. Okay, calculator, minus 50,000, and then the miscellaneous expenses if we buy the finished product. Okay, here we come to this paragraph. So we have this Kelvin. The production manager insists that the company must continue to produce. That means we should produce these components. We should not buy the component from the supplier. And the rationale is a piece of special equipment installed only a year ago cannot be used for purposes other than production of the components. And it seems that it is a waste that the company only used the equipment for 1 year. And this is the rationale suggested by Kelvin. And if the production of the component is discontinued, that means if we don't produce, however we buy, then we have to sell the equipment, and the equipment will be sold for $1,000, and written down value is same as the net book value. So therefore, part A here, we need to comment on Kelvin's rationale for insisting to continue to produce. It is because Kelvin does not want to waste the equipment because the firm just used the equipment for 1 year. Is this correct or wrong? So this is wrong, because all things happened in the past is a kind of sunk costs. Okay, so here we come to the definition of sunk costs. Sunk costs are costs that have been incurred by decision made in the past, and that cannot be changed by the situation that will be made in the future. So the situation is like we have this idiom saying that don't cry over spilled milk, and there is no use in being upset over situations that have already happened and cannot be changed. So the answer to the rationale suggested by the Kelvin would be like this. The book value of the special equipment, even though it has been used for 1 year, is a kind of sunk costs, and which is irrelevant for decision making. All right, so therefore, when we make decision whether we should buy or produce the products, we need to calculate cost, how much is cost of manufacturing, and then how much is cost of buying. Okay, so finally, if our choice is to buy, that means we don't produce our own products, we don't need any factory, and then we don't need any equipment. So therefore, we are going to sell equipment. So here we have another figure which is relevant when we buy the products. Okay, and be careful for this purchase price, carriage, indirect labor, miscellaneous, we all paid money for this, but for this we receive money, so that we need a bracket to do the opposite. This bracket stands for cash inflow, and these are all expenses that we need to pay if we buy the components instead of producing the components. So here we have the answer to part B, saying that why we need to consider the disposal value. So here only the disposal value of the equipment. Should production be discontinued, that means we don't produce anymore, is a cost relevant to the decision. So therefore, disposal value of equipment if we choose to buy instead of produce our own product. So this is 1,000, which is relevant for decision making. All right, so now here we have total cost of manufacturing is 900 80,000 and the cost of buying is 900,000. So what should be our choice? We should choose the one with lower costs, right? Because we can earn more. So after calculation of cost of manufacturing and cost of buying, we make this conclusion. There is costs of saving of buying instead of making. Because we save money, the cost of buying is lower than cost of manufacturing. The company should buy the components from the supplier. Okay, so that's all about this question in A-Level 2004. Okay, next we do another DSE question in 2014. Here, a company uses a machine for production. For each of the description, indicate which of the following cost classification is most suitable. And then now we need to do classification for part A to part D here. So now what are the choices? We have fixed costs, variable costs, and semi-variable costs. Remember, we have another name for that, which is same as mixed costs. And stacked costs is same as semi-fixed costs in the previous lesson, right? And then we have sunk cost, which is irrelevant to decision making, which happened in the past. And incremental cost is additional costs. And then now we have opportunity costs, which is the highest value option foregone. Now, the first one. A worker is employed to operate the machine for a monthly wage, 6,000, plus 0.3 per unit. So obviously, this 6,000 is fixed parts, and plus this 0.3 per unit is variable parts, variable costs. So what do you think? When we have two parts consist of fixed cost and variable costs, it will be a kind of mixed cost. But here, the name for mixed cost is semi-variable cost. So answer here should be semi-variable costs for part A. Okay, B here, the machine has a net book value 52,000. In evaluating whether to sell the machine, the net book value which is happened in the past and which is irrelevant for decision making because we don't cry over spilled milk, remember that? So therefore, the net book value for the machine should be a kind of sunk cost, which is irrelevant for decision making. Okay, the machine can now be sold for 5,000. That means this is the disposal value of the machine. If the company decides to retain and use the machine, that means we don't sell it, we choose to use it. The sellable value will be the opportunity cost because we choose to use it. Therefore, we foregone for selling it. So this 5,000 disposal value will be also the opportunity costs. Okay, finally, if the machine is sold, the company will rent the machine for 20,000 per month. Okay, so what do you think about the rental charge? Each year the same is fixed costs. All right, so that's all about today's lesson. Thank you for watching my video. I'll see you next time. Bye-bye.